There is a growing interest from a certain group of people in investments, especially in buying MTN stocks, since there was an announcement about the millions of Ghana cedis that MTN intends to pay out to its shareholders as dividend. For some of those people, I believe there's a misunderstanding of how stocks actually work and how dividends get paid to shareholders. In this video, I intend to clear that up and to tell you some of the things to look out for if you intend to invest in stocks and how to determine what is and what isn't a good stock for you. Let's get into it. Ongoing conversations under the comment section of videos teaching about investments and in stocks especially lead me to believe that many people who are now rushing to go and buy MTN stocks believe that there is a guaranteed return on their investments, that no matter what happens, they are going to get dividends or profits from their investments. But that is not how stocks work. Stocks, in my opinion, are very much like sophisticated gambling. You can make a lot of money from it, or you can lose everything that you invested in it, which is why you are advised to only invest what you know you can afford to lose, while looking towards the positive side of things. The only difference between the stock market and gaming companies is that companies listed on the stock market have every intention of putting money back into your account, while gaming companies are bent on taking money out of your account and drying you out. Now, for anybody who might feel discouraged by such things, don't be. Stocks are very simple things. Buying shares means that you have ownership in a business, and that is no different from starting a business with a close friend, with a family member, or even deciding to go solo and start a business on your own. You are just investing your money in someone's business. The only thing is that companies listed on the stock exchange have been in business for many years, some running since our childhood. The thing about stocks and running a business is that there is no way for you to know which business idea is going to perform well and thrive and which ones are going to tank after looking like they are going to be successful in a few years. But in this video, I'm going to suggest a few things that you can do when you are looking to invest in stocks that may benefit you in the long run. Whatever way you intend making your millions in life, you need to understand that money does not always come fast. So sometimes you may need to take a step back from the crowd, think and then consider certain things before you commit to certain things like investing in stocks, which are supposed to be a long-term journey. There are so many ways to invest and make money. We have heard about real estate, fixed deposits, treasury bills, and even forex trading. More often than not, and almost always, when you invest in anything, your capital is going to be at risk. Before we focus on how to decide what is and what isn't a good stock for us to invest in, I'd like to make a disclaimer. I do not recommend any specific stock for anyone to buy, and every company that I use in this video is only for example purposes. It is recommended to consult with a professional before you invest your money in anything. And if you choose to rely on this video to make any decisions, you proceed at your own risk. Stocks are simply ownership in a company. Investing in stocks is investing in businesses. Granted, there are several stocks to pick from on the Ghana Stock Exchange. The more knowledge you have, the more risk you can take. Now, when deciding to buy stocks, put your money in a company that you personally love and use, like MTN for telecommunications and mobile money, or Unilever, which produces much of the toiletries that you personally clean with on a daily basis. Imagine investing in a company that has poor product delivery, frustrated and constantly complaining clients, and even poorer customer service relationships. That is going to be a very big waste of your money, because the moment a better alternative comes up, most of those customers are going to move on to the better service that they are going to get from the other company, and you are going to lose out big time on your investments. Invest in companies that you believe can grow a lot more in the future. There is no guarantee to this. Sometimes you get it right and make a lot of profit. Other times you get it wrong and lose a lot of money. When considering companies, look out for the business that you believe will be around for 10 years or more. Warren Buffett once said, if you aren't willing to own a stock for 10 years or more, don't think about owning it for 10 minutes. And he's right. Some businesses take off after a year and start making profits, and many more also only mature after decades of investment and improvements to their processes and procedures. So pay attention to what has grown consistently over many years and even decades. Not always, but usually the largest stocks in a stock market are the safest stocks, because you know that in 10 to 20 years time they will still be around. Think healthcare stocks, food stocks, telecommunications, and energy stocks. Companies like Unilever have been around since our childhood. We have grown up with these companies, and there's a very high likelihood that even in our old age, these companies will still exist to cater to the needs of our grandchildren. There are two numbers that are important for steady stocks. That is the PE, or the price to earnings ratio, and the dividend. And I'm going to explain both numbers so that you can look out for them in the stock market. The price to earnings ratio. It sounds technical and complicated, but it's very simple. It is the price that people are willing to pay for every cedi that the company makes back in profits. Let me give you a real example. If a company makes 1,000 Ghana cedis in profits and that company is valued at 50,000 Ghana cedis, it means that the price to earnings ratio of that company is going to be 50 Ghana cedis. What that means is that investors are willing to pay 50 Ghana cedis for every 1 Ghana cedi that the company makes in profits. By the way, for some publicly listed companies on the stock exchange, you can just Google their PE ratio. Now on to dividends. Dividend is the company sharing a percentage of their profits every year with their shareholders when they deem it appropriate. It does not always happen every year for some companies, but it is possible that you can invest in a company that pays out dividends to its shareholders every year. Here is how it works. If you invest 1,000 Ghana cedis in a company that decides to pay 5% dividends at the end of the year, assuming that the percentage is fixed, what that means is that at the end of each year, where they declare dividend payments, you are going to receive 50 cedis out of the profits from the company as your dividend payment. Now you need to understand that not all of the companies on the stock exchange are going to be paying out dividends at the end of the year. Some companies pay dividends every year, others pay dividends every few years, and some companies take a very long time to pay dividends or do not even get around to paying dividends to their investors at all. And that is in addition to the profits you make if the price of the shares go up. What you need to keep in mind, however, is that when prices of stocks go up, the company is not obligated and does not in any case pay any money directly to the investors because the prices have gone up. The benefits that we are talking about here is you selling off your stocks and then getting money because you are going to sell it at a higher price than what you bought it for, which is going to be the source of your profits. So you stand a chance of getting dividends and capital gains as your total profit from that investment. One thing you need to note is that past performance is not a reliable indicator of the future results of the company. Profits can go down or losses can be made, which will lead to no dividend declaration, and stock prices can go down, leading to no capital gains or less capital gains compared to previous periods. When it comes to stocks, don't overdo it. The more you buy and sell, the more you risk losing out on, especially in a steadily growing market. However, in a period where you anticipate a decline in the stock market or in a particular company's shares, selling off your shares might save you some money. Stocks are a long-term investment and they are supposed to be very simple. Just buy and hold. In a simulation performed with historical figures since 1957, it was shown that if you buy long-term stocks and hold them for only a year and then sell them, you have a 50-50 chance of making money or losing your money. But if you hold on for 13 years, you have a 100% chance of making money. That's not my opinion, that's literally historical data. Another great quote from Warren Buffett is that time in the market is 100 times more important than time in the market. Always remember that the value of your investments can fluctuate and your capital is always at risk. I'll leave you with this quote from a famous investor and economist who once said, "Your money is like a bar of soap. The more you handle it, the more you lose it." If you are also interested in how the payment process for dividends work, you can check out my next video. Remember that this content is for educational purposes only and not investment advice. Invest wisely and safely, and I'll see you in another video about money. Don't forget to like, share and subscribe to my channel and pages. I'll see you next time. Bye.